So a few days ago, someone on Twitter asked me, please explain like I'm a kid, if you don't mind. If I have 30,000, how do I start with this progressive exposure? So this is the most common question that I get asked on my Twitter. And for some reason, progressive exposure really confuses a lot of people. In my view, position sizing is the most important thing that will determine your P&L. If you take a bigger position than you should, it can wreck you. And if you take smaller positions than you should, it's not going to move your account. So this is hands down the most important part of your trading. It's not entries, it's not exits, it's not charts, it's not fundamental analysis, it's not technical analysis, it is position sizing. But it's also the least understood. Most new traders, and this includes me when I was a new trader, pay no attention to this. Usually, this is the last chapter in all textbooks. So by then, people have exhausted their capacity to absorb information or are just lazy to really put in the effort to understand it. And it can also be a bit mathematical, which puts a lot of people off. And people don't really understand how important position sizing is to actually moving your account. So most new traders don't put in the effort to learn this. In this video, what I'm going to try to do is dumb it down as much as possible and give you a very basic, very bare bones overview of how I use position trading and how you, position sizing, and how you can use progressive exposure to maximize the returns on your account and make sure that the drawdowns are as small as possible. So what I'm going to do is first go through the two rules of position sizing, and then I'm going to apply it to an Excel sheet live here in front of you so you can understand exactly how it works in action. If the rules are just going to be the theory, right? So if this is confusing, just bear with me for a few minutes until we get to the example, and hopefully everything is crystal clear. And if you still have questions after this video on how it works, let me know, and I'm more than happy to make another video to make things clearer. Okay, so two rules. Now the first rule is when you start your trading from a blank slate, a new account, your first trade, you always risk 0.12 of your total equity. Now, don't let words like equity and total equity scare you. It just means the total number of dollars in your account. So if your account has $30,000, like that question at the beginning of the presentation that I was asked on Twitter, the total equity is just $30,000. That's it. And what you're going to do is on your first trade, you're going to risk 0.12% of this 30,000. Now, I will show you exactly what that means when we do the example in Excel. But for now, just try to remember these rules. Now, if two positions do well with this amount of risk, then we increase the ROTE, which is risk of total equity, to 0.25%. The same rule we apply again. If two positions are working well at 0.25%, then we increase the risk to 0.5%. If two positions at 0.5% are working well, then we increase the risk to 1%. If this doesn't make sense to you right now, just bear with me, and we're going to do an example of exactly how you can apply this to your account. Now, the corollary to that rule is, if two stop losses get hit, then you reduce the position size to the size below it. So from 1%, if you're hitting two stop losses, you come down to 0.5%. At 0.5%, you lose in two positions, you come down to 0.25%. And in 0.25%, if you lose in two positions, you come down to 0.12%. It's really pretty simple. That is your first rule. Now, the second rule is You always take a maximum of 2 risky positions at a time. So suppose it's the morning, you're finding 10 stocks breaking out. You're not going to jump into 10 breakouts at the same time. You only take 2 open positions, 2 risky positions at any given time. Now, what is a risky position? It's one where your stop loss is not at or above your entry price. So say I have entered a stock at $100 and my stop loss is 99 or 95. That is a risky position because if the stop loss is hit, I'm going to lose money. Now say I entered at 100 and the stock started going up and I moved the stop loss up to 100 or 101 or 105. In that case, even if the stop loss is hit, I'm not going to lose any money. So that is a safe position. You can have as many safe positions as you want. In fact, the more the better. But risky positions, we only have 2 at a time. Now, why do we do this? One is so that it caps the intraday loss to 2% of your account. Say you are trading at your full position size, which is 1%, and you have 2 risky positions, and the market suddenly starts going down for whatever reason. You're going to take a loss of 2% on your account, maximum. Now, if you had 10 open positions and each at full size of 1% and the market started to go down, that means your account would actually go down 10%, which is a big no-no. You never, ever, ever want to be in that position. In fact, you should never have a drawdown of more than 5 to 7%. Now, the other reason why we only have 2 risky positions at a time is if the market is really doing well and you've gotten into 2 breakouts, the odds are at least one of them will work out. If both of them are going to stop you out, then the market is probably not that good. You don't have to pile into 10 breakouts to find out if breakouts are working. 2 breakouts are going to give you enough information on whether the market is constructive and you can start to take more long positions or not. So try to curb the FOMO and never get into more than 2 positions per account at any given time. So, and every time one position becomes free, which is that we can move the stop up the entry price or above that, then you're more than free to add another position. And the more free positions we can keep in our account and free roll, the better. Okay, so just to recap the 2 rules. The first one is we start with a risk of 0.12%. If 2 of them work, we increase to 0.25. If 2 more work, we increase to 0.5. And if 2 more work, we trade full size at 1% risk. Say we're at 1% risk and 2 of them fail, then we reduce to 0.5. Say 2 more fail, we reduce to 0.25. And if 2 more fail, we're back to trading pilot size positions at 0.12%. Simple. This is progressive exposure. You progressively move up, you progressively move down based on whether breakouts are working or not. And the second rule was just max of 2 risky positions at any time. That's it. These are all the rules you need to know. Now we're going to go through an Excel sheet where I'm going to go through a live example of how you can start with an account of say 100,000 and how we can start to determine what the position size for each trade will be. Okay. Now I'm going to go through an example on this simple Excel sheet to show you exactly how I calculate the number of shares I should be buying for any position and how I use progressive exposure. Okay, so let's say you found a stock that you want to buy, Apple, and you have total equity in your account as $100,000. This is just the total number of dollars that you can trade with in your account. Now, remember the first rule of position sizing and progressive exposure. The first trade has a risk of total equity as 0.12%. What that means is we're going to risk $120 in that trade. Now, where did I get this $120 from? It's simply my total equity multiplied by the risk of total equity, which gives me $120. This is the very simple formula for that. So what this means is, say I'm a breakout trader, the way I am, and I find a flag in Apple, and I want to enter it at a breakout, and at the breakout, Apple is $100, and I put my stop loss at the low of day, which is $95. If my stop loss is hit, then I'm going to lose $120. That is the amount that I have risked in that trade. Now, once I know at what price I want to buy a trade and what price I want to put my stop loss at, it's very easy for me to calculate the number of shares. We're simply going to use this formula. So it's your total equity multiplied by the risk of total equity, which is $120 in this case, divided by your entry price minus your stop loss price. And I'm going to put this formula down below the YouTube video in case anyone wants to use it. But it's just really, really simple, basic arithmetic. You're seeing the number of dollars you're risking and dividing them by the spread between the entry and the stop loss. So 120 divided by $5, which gives you 24 shares. So I'm going to go ahead in my brokerage account, put in an order of 24 shares in Apple. And for the purposes of this example, let's assume the trade works. Apple goes up another 2-3 days. It reaches 110, and I want to book profits there. So I exit at 110, which gives me a profit of $240 on the trade. How do I calculate that? Again, really simple formula. It's the number of shares I bought into the selling price minus the cost price, the exit price minus the entry price. Super simple, basic arithmetic. Now, once I've made this profit of $240, it gets added to my brokerage account. And so my new total equity would be $100,000 plus $240. So the next day I come in, I now have $100,000 and $240 in my account, and I find NVIDIA. I find a similar bull flag setting up on NVIDIA, and I decide, okay, I want to take another long trade in NVIDIA. Now, remember, we need 2 profitable trades at 0.12% before we can increase the risk, right? So for my second trade, I'm going to continue trading at 0.12%, which means I'm going to continue risking $120. And let's assume NVIDIA has a similar chart where it breaks out at $100. I enter. I put the stop loss at the low of day, 95. That makes me buy 24 shares of NVIDIA. And then NVIDIA goes up for another 2-3 days. I sell at 110. And I make a profit of $241. Now, why is it $241 and not $240? That's because our total equity in this case was higher. From 100,000, we've moved on to 100,000 and 240. So the P&L is slightly higher too. But now, at the end of the day, our new total equity is $100,481. How did we get that? Remember, we made 240 from the Apple trade and 241 from the NVIDIA trade. We've had 2 profitable trades at a risk of 0.12%. So our total equity is now $100,481. So now we come into a new day. This is my new total equity. I like how my positions are working. We've had 2 profitable positions at 0.12 risk. Come in, I find Costco with a Costco with a bull flag, and that one is breaking out as well. So I decide, okay, I want to buy Costco. Now, will I continue to trade at 0.12%? No. We've already had 2 profitable trades with this risk. So I'm ready to increase my position size to 0.25. Okay. And that is simply from this rule, if you remember, which is once you have 2 positions that do well, then you increase the row to 0.25. Okay. If I'm risking 0.25% on the Costco trade, that means the dollar amount that I'm risking is $250, $251 to be exact. Now, let us think about it this way. Costco could either work or not work. Let's see the worst case example, which is that Costco doesn't work. See, I enter again at $100. I put my stop loss at 95. Now I'm buying 50 shares of Costco because remember, I'm risking more on this trade. So my position size has increased. I buy 50 shares of Costco and my stop loss is hit. So I'm exiting at $95. And what I lose on this trade is $250. After losing $250, my new account total is $100,229. So this total of $100,229 is still higher than my original equity, which was $100,000, right? So the reason we were able to risk more on this trade was that even if we hit the stop loss on this trade and lose the full $250, our equity curve is not going to dip below what we had originally put into the account. That is the main goal of using progressive exposure, that we keep the drawdowns as small as possible. So now we've simply come down from 100,481 to 100,229, but we're still above how much we had put into the account originally, which is $100,000. Now let's say the next day I come in and I find another stock, let's say Palantir. It's making another bull flag. Because we've only hit one stop loss on 0.25%, we can take another trade at this risk and try what Palantir and try our luck with Palantir. So again, we're just going to assume Palantir is making a bull flag. It breaks out at a $100 level. The low of day is 95. We put the stop there. We are allowed to buy 50 shares of Palantir. And in this case, let's see what happens when it works and when it doesn't work. So first, let's assume it does continue breaking out and it goes up to 110. In that case, we've made a profit of $500 on this trade. So our new equity is now this 100,229 plus the 500, which is 100,731. That takes our equity to a new high of 100,731. So we're now comfortably up in our account with a cushion of around $730. But suppose Palantir didn't work, we would have been down another $250 or back to 99971, which is roughly 100,000. We would have lost just $30 on the account. And we've made sure that we are not dipping down too much below what equity we had originally put into the account. That is the whole idea behind this. Now, because I have gone slightly below where my original account had started from, my next trade, say it's in Lantheus Holdings, I'm going to go back to risking 0.12%. Remember, 2 losing trades, and we go back down 1 level in risk, 2 winning trades, and we can increase the risk, right? Now, let me show you an example. Let's assume that Palantir did work, and we were comfortably up to 100,730. Then, in my next trade, what would I? So then, in my next trade, I will continue to risk 0.25% because to increase the size from 0.25 to 5 to 0.5, remember we need 2 winning trades. In this case, we had 1 losing trade, 1 winning trade. So we need 2 consecutive winning trades to be able to increase the size. So here I take this new stock, Lantheus, risk another 0.25%, which is $250, and say Lantheus is also making a bull flag. We're entering at the breakout level of 100, putting the stop loss at the low of day, which is 95, buying 50 shares of Lantheus, and let's assume this one works as well. So it goes up 2-3 days, and we decide to take profits at $110. That means I've made another $500 on this trade, and my new equity is now 100,000 and 1, 2, 3, 4. $100,000, $101,000, basically. So because I've now had 0.25% 2 trades that have worked and made me profits, on my next trade, I'm allowed to risk 0.5%. So let's say I find another stock. I'm just going to assume something random, Mara. I'm risking 0.5%. And now the amount of dollar risk that I'm taking on this trade is $500. Now, at this point, I don't want to go through the whole example, and I don't want to keep doing the whole entry and the exit. What I want you to understand is the importance of this number and this number. So I now have an equity of $101,000. I am risking on this trade $500. My goal is to never dip too much below this and to never take a big dip in the equity curve. If I lose in this trade, I'm going to lose another $500, and that'll bring my equity down to 100,000 and 700, which is still going to be above the amount that I originally put into the account. That is the reason that I'm allowing myself to risk a bigger and bigger amount the more traction that I'm getting. Say this one is a loser, and we exit again at the stop loss, and I'm back to 100,728. And say I take another one, this time I take Bitcoin, and this one is also a loser. I am now back down to $100,200. Pretty close to where I started from, but still in the green, and haven't taken too much of a drawdown in my equity curve, a total of just 1%. Now my subsequent trades would be at a risk of 0.25% because I've taken 2 losers at 0.5%, right? Remember these rules. If you get 0.5%, you're going to move down to 0.25%. If you lose towards 0.5%, you're moving back down to 0.25%. Say if both of these had been winners, we are now up by $3,200 on our account, and we would be able to move the risk up to 1%. That would allow us to risk $1,000 on the next trade. And I'm sure by now you've picked up a bit of this. If we lost on this trade, out of the $3,200 cushion that we now have on our original equity, we're now down to $2,200. still in the green. And if we were to make money on this trade, we would make $2,000. And that would give us a new equity, a new high of a new equity high of $105,000. So our account would be up by $5,300. Hopefully this gives you a sense of why we are reducing and increasing the position sizes from 0.12 to 0.25 to 0.5 and eventually to 1, and why every time we take losses, we have to scale back down. Remember, think of your equity curve as a bull flag, in fact. So you always want to be making new highs in your equity curve, and the pullbacks or the drawdowns in your equity curve, you want to keep as shallow as possible. And whatever is the original amount that you start from, say $100,000, you want to try as much as possible not to lose too much. So hopefully this video gave a little bit more clarity on what position sizing is, how I use progressive exposure, why it's important, why it can help you keep your drawdowns really, really low. And if there's any particular thing that I missed out on or that needs a bit more clarity, let me know and I'll do my best to answer the questions. But I would strongly encourage you to do two things. One is watch this a couple of times to really get a hang of it. It's not very intuitive at first and took me a long time to understand it too. And the second is review Minavini's literature, especially his second book, Think and Trade Like a Champion. That one goes a bit into detail of how he uses progressive and it's very similar. And that can give you a bit more detail, get really deep into it. Thank you, and let me know